moved lower since our last report, following signs of easing tensions between market seems to be on track to end the week in the green, thus continuing their 3-week winning streak. In today's report, we would like to address what fundamentally seems to be driving them and then narrow our focus on Amazon's recent developments in addition to the implication of the US tariffs on Chinese imports. We conclude our report with a technical analysis of Nasdaq's daily chart. The US CPI rates for April are set to be released later on today. At this point in time, the expectations are for the core CPI rate on a year-on-year level to decelerate to 3.6% from 3.8%. Furthermore, the headline CPI rate is also expected to decelerate on a year-on-year level to 3.4% from 3.5%. Thus, should the US CPI rates come in as expected, hence implying easing inflationary pressures, it could increase pressure on Fed policymakers to reduce the tight financial conditions surrounding the US economy. Thus, the implication of the Fed easing its monetary policy could provide support for US equities across the board. On the flip side, should they come in higher than expected and hence imply persistent or even an acceleration of inflationary pressures, we may see the opposite occurring. Following last week's agreement in which Amazon reached a deal with Telefónica Germany to move 1 million of their 5G customers to its AWS cloud, Amazon has announced another expansion project in Europe. The company announced on Wednesday that it plans to invest roughly 7.8 billion euros in order to build cloud computing infrastructure in Europe and in particular in Germany. The move could be seen as a precursor to future deals, as the deal with Telefónica last week could only be the beginning. Furthermore, the increase in infrastructure to service its European customers could be in order to facilitate future integrations into Amazon's AWS cloud services, which could yield higher revenue in the future should it attract more customers. In conclusion, the implications of an increase in future revenue for Amazon could provide support for the company's stock price. On Tuesday, the 14th of May, the US government announced that it will be expanding its existing tariffs against a wide range of Chinese imports. In particular, the US government quadrupled EV duties to over 100, which would make the import of Chinese EV vehicles significantly more expensive for US consumers. On the other side, domestic EV manufacturers such as Tesla could potentially benefit as they may face reduced competition from Chinese EV makers whose vehicles may have been a cheaper alternative. Furthermore, the announcement also included a doubling on Chinese semiconductor duties to 50%, which could benefit Intel, which produces and manufactures its own semiconductors in the US. Overall, the two aforementioned companies' stock prices could benefit as they may face reduced competition from China and thus may retain or even increase their respective market share of the US EV and semiconductor markets, respectively. However, as it was reported by Reuters, the US imports a relatively small number of Chinese vehicles. In addition, the updated tariffs also include an increase in lithium-ion electric vehicle batteries and critical materials to 25%, which could increase the cost of production for Tesla's EV vehicles whose lithium battery supply originates from China. In conclusion, it is our view that we may see a temporary boost to US-based EV makers such as Tesla, yet in the long run it could actually impact the company negatively should it fail to secure a significant lithium provider outside of China. Whereas Intel's more diversified network of procuring raw resources could benefit them in the long run. In conclusion, we would personally adopt a wait-and-see strategy for Tesla, as the true impact has yet to be seen and any upside potential could be temporary. Nasdaq, since our last report, has managed to continue on its upwards ascent, with the index now appearing to be taking aim for the all-time high figure at the 18,500 resistance line. We tend to maintain our bullish bias for the index, and supporting our case is the upwards moving trend line, which was incepted on the 19th of April. In addition to the formation of a morning star pattern on the 1st of May, serves also as a legitimate bullish indication for the index's direction. Yet we would like to note that the bulls may face heavy resistance as the index nears its all-time high figure. Nonetheless, For our bullish outlook to continue, we would like to see a clear break above the 18,500 resistance line, with the next possible target for the bulls being the 19,100 resistance level. On the flip side, for a sideways bias, we would like to see the index remain confined between the 17,800 support line and the 18,500 resistance level. Lastly, for a bearish outlook, we would require a clear break below the 17,800 support level, with the next potential target for the bears being the 17,000 support base. Thank you for tuning in to our financial report today. We hope you found it useful. Until our next update, from all of us here at IronFX, we wish you a solid trading.